Okay, fam, welcome back. So today I'm going to be going over how to basically showing you guys how I would build a dividend portfolio if I was going to build one for retirement. So with that being said, let's get it. All right. So first thing I want to go over here is serve robotics. So look, this thing's creating higher highs and higher lows. I do think it's getting ready to break out. I did actually get into this a little bit late. Ideally, the best time to get in is exactly the exact candle that occurs when the actual golden cross happens, which would have been way back here, roughly about $8. So got in a little bit late, but again, it does look like it's going to break out. Okay, so we're getting higher highs and higher lows, and we told you about this before. We're still in the trade, basically looking for somewhere around, I'd say probably 12 to maybe as much as 15, somewhere in there as a potential return. So about 20 to 30% gain. And just to prove to you that I am not lying to you and that the trade is still on, you can see it right down here. Okay. All right. So let's go ahead and get into this dividend portfolio stuff. So here's kind of the idea. Okay. So first thing you got to figure out, or I should say, first thing I would want to figure out is how many positions do I want to have in my portfolio in total. Okay. So the numbers that popped into mind was roughly about 50, 60, or 100. So if I'm looking to invest just into dividend paying stocks or mostly into dividend paying stocks going into the next 30 years, I'd probably want to have 100 positions. There's a couple of reasons why. One reason is because if I were to have 100 positions, 100 separate, completely different positions in dividend paying stocks, completely different funds, different stocks, all that, none of them are going to be the same. Okay, they're all going to be different. If one of them were to fail to go to zero, it would only affect 1% of the total income. If five of them were to fail, which again is very unlikely to happen, that's the chances of that happening is probably less. Or let me rephrase it like this: the chances of you getting struck by lightning are probably greater than 5 out of 100 of your positions going to zero if you pick them correctly. So there's that. So basically, the massive diversification offers a very high level of protection, especially during something like a bear market or a correction or some kind of crazy flash crash. So the second reason why there would need to be so many different positions is because we would basically plan on having different types of dividend investments in the portfolio. Okay, so roughly about a third of those would be in high yield dividend ETFs. The other third would be in something kind of in between low yield, high growth and low growth, high yield, something like that. So somewhere in the middle, something like a GPIC or an SPYI, or I wouldn't necessarily say something like JEPQ, but something like maybe a PDI or SVOL or something like that. Somewhere in the middle of the two. And then on the opposite end of the spectrum, the last third of the group would be something that's high growth, relatively low yield, but it does increase yield over time. Something like an SCHD, DGRO, even something like JEPI, JEPQ, things like that. So roughly about 30 of the super high yield ones, 30 of the moderate yield ones, and 30 of the low yield ones, just to kind of get a good mix of a combination of passive income and growth potential. All right, so I'm going to give some examples here of basically what we'd be looking at. So among the high yield ones, and before I go any further with this, I did want to show you guys these dividends that were recently announced. So today we got the declaration for some of the yield max ETFs. So we got YMAX, YMAG. YMAG was shockingly large. I wasn't expecting it to be that big, but hey, thank God for the increase. So NVIDIA, $1.10. And then you got DIPS, FB, GDXY, Babo, BABO. I'm assuming that's Alibaba. That one was pretty huge. Of course, you guys already know the China rally that just happened was absolutely, that was insane. I've never seen anything like that. And then you got the JPMO MRNY, which we do have this one. And then Palantir or PLTR. Personally, I wouldn't really buy the Palantir one. If I was just going to do this, I would just buy the actual shares and do the wheel on it. I mean, it's good to have. It's good for the passive income, but then again, it's. I mean, we would only want to own a certain number of single stock ETFs because it's not good to have too much overexposure to single stock ETFs. So there's that, and then QDTE, XDT, and RTTE did announce theirs as well. So you got 27 cents per share here on QDTE. Going down the list, XDTE roughly about 18.5%, and this one is just over 20 cents, so that's pretty good. It's less than last month, but again, QDTE did come in higher than, or not last month, last week. QDTE did also come in higher than last week, so it kind of offsets that. And then RDTE, we don't see what this one is yet, which is kind of odd, but yeah, you can see the payment here is not as good as it was, but then again, the market has kind of been digesting and processing previous moves and trying to get ready for the earnings and CPI and all this other stuff that's coming up the elections. Because again, we are in the most volatile time of the election year. Okay. So the fact that the market is just chopping sideways, in my opinion, is actually a good thing because, it could be doing the opposite. It could be dumping. Again, I don't think that's going to happen. I'm expecting the markets to go up, but, this is what I refer to as a pullback in time. Okay. Basically, the price just chops sideways while the indicators reset. That's a pullback in time versus a pullback would be an actual pullback in price, which I think we're not likely going to see. Okay, so we went over these dividend announcements. So in terms of the high yielding ones, things I would be looking, again, with the first third, some of the funds I'd be looking to buy would be something like YMAX, YMAG. I might buy NVIDIA because, again, that's a single stock ETF. But again, NVIDIA, generally speaking, is very bullish. It's the king of the AI stocks and king of the Mag 7. They're pretty much the ones that have the stranglehold on the chip market and the AI market. I'm not expecting that to change. So I probably would pick that one up as well. And of course, we have MSTY for the bull run for crypto, but once that's over, we'll be out of that. And then, of course, we would pick up something like RDTE, QDTE, and XDTE. If they had any other higher yielding dividend ETFs like this, we would definitely buy some that were relatively stable in price. SPYT is another good one. I think that's another good choice, in my opinion. Because again, during the August flash crash that we saw, which was just crazy. That was insane. If I go over here to the actual share price performance over the max time frame, you can see that during that massive sell-off in the Nasdaq of, I think it was like minus 17%. Again, this is based on the S&P, but the S&P was down a lot as well. This thing only went down from basically 2050 to about 1850. So it didn't really drop that much. It only went down about 10%, and then it pretty much recovered almost all of its previous drawdown that it had. So in my opinion, this would also be a good high yield one. Maybe this one and something like QQQT. So in terms of kind of the mid-range yielding ETFs, like a combination of potential growth and relatively high yield. And again, this one, because of the fact that the yield is still a little bit higher than normal, which kind of pulls away from the price appreciation a little bit. I would be doing position trading for this one. I'd basically be buying at the support, trying to get out at resistance, and collecting passive income in between. This is what's known as trimming in the passive investing world. A lot of people refer to it as trimming. Basically, they look to take a piece of the profit off the top, move it into another position that's undervalued as a way to grow their passive income and their overall capital without actually having to put more money in. So positions like this that I'd be looking at would be something like ACP. We've had this one for a long time. It's actually done quite well. And again, the price hasn't even gone up yet. BSTZ, that's a decent one in my opinion. They just raised their dividend as well by like a lot, like really a lot. I'd probably only own one of the CLM and CRFs. I'd probably just go with CLM is what I would do. Something like maybe PDI would be a decent one. NUSI would also be a decent one. Again, not all of these are going to go straight up in price, but some of them do. You can see NUSI's return here has been absolutely insane, and this one's relatively decent yielding. I think it's like about 10% or so. PFLT, SVOL, those would all fall in that group. Maybe even something like QYLD, although that one, in terms of price, it hasn't performed that great. RIV, OPP, RA, these, even something like TLTW, these would all be ones that we pick for kind of middle of the range. So in terms of the back end of the range, or the lowest yielding, highest growth potential, we would be picking something like, see if I can find it, JEPI would be one. Actually, it'd be easier if I do this on Robinhood so you guys can see it much easier. Okay, let's go JEPQ, because again, I am nothing against the S&P, but I like the NASDAQ personally more. Okay, if it ever loads, there we go. All right, so you can see JEPQ has had a very nice price appreciation over the last year. Again, this isn't going to go up massively in value overnight. It takes a little while, but it's it's a combination of both yield and growth, so that's really what matters here. If I go over here to the dividends, you guys can see what those dividends would come out to be. So they're pretty good. I mean, a recent one was pretty high, 55 cents. You can see it ranges between 36 to 55. Again, this is a volatility-based ETF, so it depends on how volatile the markets are. Another good one, in my opinion, would be something like a GPIX. Again, that's kind of the middle of the road ETF. SPYI would also be a middle of the road ETF. Relatively low expense, lots of assets under management. Modest yield, not super low, not super high. And the dividend payments, in terms of people worried about consistency, would be very consistent. So there wouldn't be a whole lot of deviation there. Lower yielding ones, another good one, in my opinion, is SCHD. A lot of people in the high yield community, they bag on this one, but I think it's good to have some diversity. This one has performed quite well over time. And this is, if I remember correctly, this is basically an ETF made of pretty much all the dividend aristocrats and dividend kings, and just anything that pays growing dividends over time. So the yield naturally is going to grow, and the price of the ETF is going to grow. As you can see, it's a very, very good price appreciator. Another one could be DGRL. So let's take a look at the dividends on these ones. SCHD. So you can see the dividends are not really consistent here. They do kind of fluctuate. There are also on a quarterly basis. Most of the ones that we look at are on a monthly basis, but it doesn't hurt to have a couple quarterly ones in there if it's ultimately worth it. So 3.5% yield, again, as long as it's outpacing inflation, that's always a good sign. Plus you get that price appreciation on top. And then you got DGRO. So this one also pays pretty decent. This is also quarterly. But if I go over here to the share price, DGRO, you can see that this thing literally just goes up and to the right. I mean, since 2015, this thing has more than doubled in price. And again, a lot of people don't want to wait that long. They're like, oh, I don't want to wait 7, 8, 9, 10 years. That's part of the reason why we do things like crypto and day trading and swing trading and options, because, we want to grow the capital on top of growing the income. It's not just about the income. It's about capital creation, right? That's kind of the whole point of this. Some people just want to do the dividends. They don't care about growing capital, or they just like, oh yeah, I'll just grow it over 30 years. We're not like that, but some people are. So this would be on the lower yielding category. Again, pretty much in terms of the high yields, I'd want to find like 20 or 30 that's kind of in this group right here, the QDTE and YMAX, YMAG. Kind of middle of the road, something like GPIC, GPIX, and SPYI. QQQI, and then on the low end, something like SCHD and DGRL. And in terms of like, if we had 100 positions total, we would have them for diversity and protection, but we would also basically, the goal here would be to make sure that each respective position paid a certain amount of money every month. So the high yield ones would probably need to pay right around $100 a month per position. And again, this comes back to how many dividends would actually be collected on a monthly basis. The kind of middle of the road ones, we'd be looking somewhere between, I would say about 30 to 50. And then the lower yielding ones, probably somewhere between $20 to $30 a month. If we could get each one of these up to 50 to 100 per month each for all 100 of them, that would be better, because that would be somewhere around $5,000 to $10,000 a month of passive income. We wouldn't need to do anything to actually get paid that money, except just be invested in the markets. And if positions needed to be managed, they could be managed. If not, we could just sit there and let it do its thing. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.